What is a credit spread? A credit spread is simply a combination of two options. We're going to dive into what options are, etc. But a credit spread is basically selling one option, okay? And you're going to make money on that short option. Someone's going to pay you money to sell that option, and then you are going to spend some of that money on your own insurance on the long option. That's all a credit spread is. So this little slide here, I'm gonna dive into a little bit more of options. All right. Okay. Okay. So things are just keep popping up. Fun times. So first things first, we're going to answer these questions right here. What are calls and what are puts? For people that are brand new to options, I will include a full course on everything options that I've done to walk you through it. And so that'll be a part of this. You can just click and watch that. But I'm going to give you a really rough rundown right now. Very, very simple. Again, not teaching you everything, just the basics of what you need to know to make money with credit spreads, okay? So what are calls and what are puts? Calls make money as the stock goes higher. Okay, they increase in value as the stock rises up. Puts increase in value as the stock market goes down. All right, so a call, one of the easiest ways to understand what a call is whenever we are buying a house. So let's say you've got this beautiful home, a window, it's gorgeous. You've got a house and a little front path, and you're going to go buy this house. This house is currently for sale for $300,000. And you put some earnest money down to get into a contract. So you buy this, you're under contract to buy this house for $300,000, and you spent $5,000 in earnest money to do that, right? So that money is gone. No matter what, if you buy the house, cool, it goes towards it. If not, that money's gone. If you back out of the contract, the seller of the house keeps that $5,000. That's the earnest money, right? And with that, you have a time frame. Let's say you have 2 months to buy this house, to finalize all the paperwork and get it bought. Okay? That's all a call option is. So a call option is literally a contract with you and anyone else out there. It doesn't really matter who. The market just going to say, hey, I want to buy a call. A call is you agreeing to buy the stock at a certain price. You can back out of that contract and lose your earnest money, the price that you paid on that call, or you can exercise that call and buy the stock at whatever strike price you have. The strike is the location of the option where it actually becomes valuable. Okay? Where it actually comes into, I guess I should say, where it becomes effective, right? I'll explain that more in just a second. So in this scenario, across the street, there are two options, okay? Across the street, there is either going to be a beautiful park built. Here's a nice little slide. I'm quite the artist, if you didn't know that. It's going to be a park built across the street, or it's going to be a nasty waste transfer facility. All right, we don't know which one, but we're going to find out in a week and a half. All right, you have 2 months to buy this house. A week and a half later comes out, and it turns out that they are going to build a park across the street. That's what the city voted on. So the value of this house just immediately went up to $350,000 because of this park. Wouldn't that be great? Awesome. So you could buy this house for $300,000 and instantly have $50,000 equity in it. Or you could go to someone else and say, hey, do you want to pay me $10,000 to have my contract to purchase this house that's worth $350,000 for $300,000? Why would someone pay you $10,000 for that? Well, because they're instantly getting $50,000 in equity. So they're like $40,000 profit on this thing. Heck yeah, I can turn around and sell it to someone else and make $40,000. Yeah, I'll pay you $10,000. You're happy because you spent $5,000 and you just made $10,000. You never even bought the house. The buyer's happy because they can buy the house now and they have instant equity. What if scenario 2 came into play and they built this waste management facility? Well, let's say the house drops from $300 to $250 now. It's only worth $250,000 now. You can either walk away from the deal and lose your $5,000, It's much better than losing $50,000 on the house or being upside down on it. Or you can buy the house and be underwater by $50,000. It's up to you. So you can do either or. When it comes to the stock market, how do we apply this? Well, let's say the current price of the stock's at $100. Okay? And you buy a call, which is an option to purchase the stock. Let's say you buy the 110 strike call. So at $110, you can buy this stock. Now, you do the same thing. You buy it that has a 2-month expiration. So you have a contract to be able to buy the stock at 110 that expires in 2 months. Well, if the stock goes to $140, let's say you spent, again, just to keep it simple, $5,000. They're not going to be usually that much, but it could be. Let's say you spent $5,000 to get into this contract when the price was at $100. Well, now the price is at $140, and it's still got a month left on it. You could either exercise this and buy the shares at $110, because then you're instantly going to have $30 worth of equity in it per share. Or you can go to the market and say, hey, who wants to pay me $10,000 to own a contract that allows you to buy this stock at 110, even though the current price is at 140. Making sense? Kind of getting it? Cool. What happens now? What happens now if the stock's at $100 and you buy the 110 strike that expires in 2 months and you spend $5,000 on it, and in a month and a half the stock's down at $80? Who is going to buy your contract from you to buy the stock at $110 right now? No one. They're just going to go to the market and buy it at $80. Like, who would buy the stock at 110 when it's currently sitting at $80? So what is the value of your contract right now? Worthless. No one's going to buy that from you. There is no value to it. So you spent $5,000 on this. It's now worth $0. You've lost $5,000. Most of the time, it's not that expensive, but you're getting the point, right? That's what a call option is. A put is simply insurance on the stock market. Did you know you can buy insurance on the stock market to protect your position? Pretty cool, right? So let's say you've got a car. Oh yeah, this is going to be a car and a half right here. You've got a car, right? You have premium that you have to pay to insure this car. Let's say it's $100 a month. You have terms, right? Your term might be for a year. It might be for 6 months, and then your term renews and you have to repay whatever the premium is. It's the same thing in the stock market. Let's say you own shares at $100 and the current stock's up at $200 and it looks like it's double topping and about to drop. If you bought insurance to protect your shares, one put covers 100 shares. Okay? So if you had 500 shares of this, you'd need to buy 5 puts. The same thing with calls. Calls cover 100 shares. Once you buy puts, wherever your strike is, so again, this is at $200. Let's say you bought the 180 strike puts. Your insurance is going to kick in once the stock drops below 180. If it stays above 180, your insurance is not valid. It doesn't do anything. Anything above a put, it's worthless. That's what a put is. Okay? Cool. Hopefully this is kind of making sense. So let's talk a little bit more about how these options are priced in. Okay? Type in a 1 if this is making sense so far. Hopefully it doesn't blow up Zoom. Type in a 2 if you're like, I'm struggling a little bit. Okay, we got mostly 1s, a couple 2s. If you've got a 2 in there, then re-watch this recording. It'll be posted. I'll email it to you here soon. It'll also be on your dashboard once the 4 weeks are up. It'll all be edited and into your dashboard. Okay. And then also, if you're struggling with this, email me, Tony@reallifetrading.com. Let me know. Say, hey, I'm struggling with options. I will send you that course for free on the options. It's all going to be there. Cool. Give you more explanation on that. Okay. So let's talk about how options values are created. You need to know this in order to be successful with credit spreads. All right. So every stock has an expected move. Some stocks move $20 in a day. Some stocks move 10 cents in a day. Every stock is going to be different, right? For SPY, a $2 move on a stock might be a pretty big day, but for Tesla, a $30 move is a pretty normal day on Tesla, right? It's all going to be different. And so every stock has their expected move. So again, with this analogy, let's say the stock's at $100 and this stock moves $10 a day. Okay? On average, some days are $5, some days are $15. On average, it's going to move about $10 a day. If you bought a call option, if you bought the 150 strike call option that expires in 3 days, what did we just do? Well, we agreed to potentially buy this or flip it to someone else if the stock is up above $150. Well, here's the thing. This stock moves $10 a day. So on day one, it goes up $10. Day two, it goes up $10. So now it's at 120 bucks. Day three, it goes up $10. Now you're at $130 and your option just expired. What just happened to the value of your option? You were correct. It went straight up. Does this option have any value? Is there anyone going to buy your shares at $150, your contract to buy the shares at $150 if the stock's at $130? No. No one's going to buy it. It's worthless. So your option is worth $0. You were correct. You bought it here and it went straight up. Well, Tony, calls gain value as the price goes up. It does. But it only has value for a call if it's above your strike price. Everything else is hope. Okay? So let's talk about intrinsic and extrinsic value. Anytime an option is out of the money, so if we're talking about calls, anytime an option is out of the money, which means the current price is below your strike, you can choose whatever strike you want. You could choose at the money, you could choose in the money, which is below it. So if the stock's at $100, you could buy the 95 strike calls right away. You could buy the 130 strike calls right away. It's up to you, whichever one you want. The ones further out of the money are going to cost less. The ones closer, when I say in the money or at the money, that's where the current, at the money is where the current price of the stock is at, okay? So if the current stock is at $100 right now, at the money strike would be $100. Out of the money is anything above 100. 101, 105. They technically have $0 worth of value. There is no value to them. So if the stock's at $100 for calls, talk about puts in a second. The stock's at $100 and you buy the 110 strike call, what's the value of that call? 0. So then why does it cost money to buy that call? Because there's extrinsic value on this. There's hope. There's hope that during the time that you have, let's say there's 20 days on this option, there's hope that during the 20 days, this will get up above 110. And based on the probability that that's going to happen, is going to price in how much this is going to cost. So technically, this option's worth nothing. But it's still going to cost something because hope is worth something, right? So you are pricing in hope. Whenever we're talking about puts, puts are in the money anytime the price is below your strike. Anytime your strike is below the current price, it is out of the money. It's technically worthless. So if the current price is at $100 and you buy the 90 strike put that expires in 10 days or any days, expires in 1 day, 100 days, it is technically worth $0. You're still going to spend money on it, but there's no value to it because Who is going to sell you their shares at $90 if the current price is at 100? No one. A put is basically talking about selling your shares, right? It's insurance. So if we are buying a put at $90, the price is at 100, it's currently worth, the only value it actually has is the hope value, the chance that the stock can get below $90 within the expiration. This is where the game's going to start being played, okay? So if we were buying puts, go back to puts, and the current stock's at $100, if this stock moves, let's say again, $10 a day, that's the expected move. What would be the worst thing you could do when you're buying puts? It would be to buy a strike so far out of the money with not that much time on it, where there's not a high chance that this is going to come to that strike and actually be worth something by expiration. That'd be the worst thing you could do, right? So the best thing you could do would be to buy something with more time, let's go 100 days, and do it closer to the money. Why? Because it's still out of the money, so it's going to be a little bit cheaper, but there's a higher chance that this could get down to, $95 within 100 days than it would getting down to $50 in 7 days. Because if it only moves $10 a day, it has to be perfect in order for this thing to make any money. All right, are we starting to make some sense here on kind of like what gives an option value? Type in a 1 if we're good on that. Type in a 2 if it's like, maybe. Again, if it's a 2, message me. I'll send you some stuff. But I'm going to include into this course the full options breakdown to kind of walk you through in more detail of how this all works, okay? This is just very rough, kind of going over, giving you the basics. Okay? So, again, wherever your strike is, so we're going to focus on puts right now because this strategy is mainly about bull put spreads. So let's talk about puts. All right. A put. So if the current price is here and we did a put down here, as the price moves down, the value of this put increases. Because the probability now that it can get below your strike within the certain amount of time that's left on the contract, again, you can choose the time. You can choose 1 day, you can choose 600 days. You choose the time. The further out in time, the higher the probability that it can get down there, the more pricey it's going to cost to do that option. The shorter amount of time and the further away it is, the cheaper that option is going to be. Why? Because we're all talking about probabilities. What's the probability that the stock is going to go from here to here within your allotted time? If you give this thing 100 days to move $10 and it moves $5 a day, there's a very high probability it could get below it. It still doesn't mean it's going to, but the probability it could, right? It's very feasible based on the expected move of that stock that it can get from here to here within 100 days. What about 3 days? The probability is a lot less. It's still possible, but it's less. And so the value of that option is going to be cheap. The higher the probability, the higher the payment. The lower the probability, the cheaper the option, but the less chance it's actually worth any by expiry. Okay? Very good. Very zoomed. Okay. Sorry. This dumb thing. For some reason, the chat just keeps crashing, so I'm going to just leave the chat off for right now. Okay? It just crashes Zoom every time. I don't know what's going on with it. Okay. So, the whole idea now of buying options is it's trying to flip it. I would say over 95% of the options out there in the market are people trying to flip them. They are buying puts down here, hoping and expecting the markets to go down, and they're going to buy these puts for cheap, and as the markets move down, the puts become very valuable, and they turn and sell it to someone else for more than what they paid for it. All right? That's the game of the options. Almost everyone is flipping these things. Not always, but a high majority of them are trying to flip these options for money. The game of selling options, that's what we're going to be doing. We win when that option expires worthless. Okay? Think about it this. Again, if I have a car, that's pretty bad, but you get it. This one's going to be a truck. There we go. I've got a truck, and I'm going to turn around, and I'm going to sell my truck to Marta. And I go, Marta, here's my truck, $5,000. And she's like, done, sold. And she buys my truck for $5,000 from me. I'm like, sweet, I got 5,000 bucks. 2 days later, I'm like, oh, crap. I need my truck back. And I go to Marta. I'm like, Marta, can I buy my truck back? And she goes, sure, Tony, you can buy it back for $10,000. She's a businesswoman. And so if I were to get my truck back, I would lose $5,000, right? I got paid $5,000, but I spent $10,000 to get my truck back. That's a losing proposition. What if she was kind and was like, you know what? I'll sell this truck back to you for, $3,000. Fantastic. I got my truck back and I got a couple $1,000s in my pocket for profit. That's what we're doing for options. Okay? We are going to sell a contract. We are going to sell an option. And we are going to get paid right away to sell this option. Again, if this is over your head, or if you're feeling lost, don't worry. Like I just said in that previous slide, you can learn this. It might take a month, but you'll learn this. It's worth your time because I'll explain to you and show you how this is one of the best ways to make money. If the stock is at $100 and we know this thing moves, let's say $1 a day. If we sold an option 10 days out and we sold this thing $15 away, is it possible that it could get there and be in the money? It's possible. Yeah. What's the percentage likelihood of that? It's basically got to drop and move its expected move every single day without any real bounces coming in for this thing to have a chance. The probability is pretty low. And so if you got paid $1,000 to sell this option, and then the price goes lower, but it runs out of steam and it runs out of time. And so after 10 days, the stock only went to, whatever, $97. This put, we're talking about puts here, this put is worth what? If it's above the strike by expiration. Worthless. It's worth $0. So you got paid $1,000 and you can either just let it expire and keep your $1,000, or you can spend some money and get out of the option. But the idea is you want to spend less than what you got paid. That's how you win. And so you can put the odds in your favor that you are almost always going to win. How cool is that? We are going to sell further than mathematically and probabilistic with a probability something. The probability is it's not going to make it to our credit spread. So we are being the casino instead of the gambler. We are selling options at the right locations at the right time to give us a 90% chance or higher that it will not get below this mark and we'll be able to keep our money. So we're going to get paid hundreds of dollars and all it has to do is stay above this. That's what we're going to be learning how to do. And that's why I gave you this breakdown so you could kind of understand how options are working. Pretty cool, right? Okay, so let's talk about now what a credit spread is. Of course, a credit spread is going to have a strike price. You're going to have an expiration date. The further out in time you go, the more premium you are going to receive and the further away from the stock you can sell it. But Like I said previously, the more days that are on it, the higher the probability that it has to move, right? If a stock has 30 days, it can make a pretty large day in 30 days, in a pretty large move in 30 days, right? So we're still going to sell it where it's outside of that move, but there is a little bit higher percentage chance that it could actually get there. But with that risk, we also get paid more money. So on average, we're going to be selling these credit spreads that I'm going to be teaching you on this strategy. Again, in part 2, we're going to learn very short-term strategies, etc. So you can get in and out, win very quickly, and it's really cool, really fun, and make tons of money each week. This, again, is focused a little bit more on a monthly basis. So you'll get into a credit spread, and odds are you're going to win on it anywhere from like 2 to 12 days. And so you can kind of do a few of these a month and get pretty good money coming in. All right. And that's the goal. So the further out you sell this thing, the more money you're going to make. All right. The closer to expiration you sell, the less exposure to time you have. You can win on it quicker, but you also end up selling it a little bit closer to the stock price. So it's a little bit harder to get good premium. Again, I'll teach you that in part 2. Part 1 right now, we're going to focus on these 30-day spreads. It's a really good money spot, and it gives you really good returns with a very high probability. Because again, we're stacking the odds in our favor, where we're putting math on our side where it's like, odds are it's not getting to this level. Okay. The benefits of credit spreads: you don't have to have perfect entry timing. Again, if the stock pulls down and you sell a credit spread down here and it keeps on going lower, that's okay, because you're still going to win if it does this. You don't have to be perfect on your entry, which is so amazing, because that's one of the hardest things that people struggle with in trading is their entry timing. They get in at the wrong time, they get stopped out. It's really hard to be perfect. Credit spreads, you don't have to stress as much about that. Another benefit is very consistent income, because you're giving yourself the best chance to win, like we just talked about. You don't tie up as much buying power, and you're still able to collect a lot of premium with credit spreads, because I'm going to explain this in just a second. I'll wait on that. But it's not going to take a whole lot of money. You can get paid pretty well. Now, the downside of credit spreads, and I'll show you how to offset these downsides. You're going to be risking more than you're making. So you'll have to risk, $500 to possibly make 50 bucks. Now, how do you succeed at this? You have a very high win rate. So you hardly ever lose, but when you do lose, they tend to be larger. I will teach you how to lose small on credit spreads. Don't worry. The next downside is it's a little bit easier to mess things up and putting things into your broker. We will go over exactly how to do that and exactly how to put these into your broker, okay? And I'm sorry, I'll get to chats here in a second, because it keeps crashing every time I open them. So I'm just going to wait for a second. I'll get to it, I promise. Let's give you an example of what this is, okay? If you just sold a put right here at the $80 strike, you're looking at this stock right here and you're going, all right, this stock moves a couple dollars a day. It's at $100 right here, basically. What are the odds it gets down to $80 within 30 days? There are some probabilities there, etc. But the thing is, what you're doing by selling this, you are agreeing to buy these shares if you sell a put. Well, it's 100 shares per put, which means you got to have a minimum, $8,000 in your account to do this one trade. Well, you might not be doing one contract. You probably want to do 10 contracts, because you don't want to get paid $50. You want to get paid $500 to do this trade. That means you got to have $80,000 in your trading account in order to do this trade, because your risk is all the way down here, right? If the stock comes all the way down to $50, you still have to buy it at $80. And so now you're going to own the stock at 80, even though the price is all the way down at 50. So there's a lot of risk, and it ties up a lot of buying power if you were just to sell a put. This is not a credit spread. If you were just to sell a put, it's called a naked put, not covered. That's the downside. What about a credit spread? A credit spread is 2 options that we're going to be having done at the exact same time. This is what a vertical spread is, okay? We are going to sell the 80. And then at the exact same time, we are going to buy our own insurance, and we're going to do this $5 further away. So what happens here when we do that? The sold leg, because this is closer to the current price, it has a higher probability, which means it's worth more money. So we're getting paid $600 to sell this, in this example. The put down here is further away from the current price than this one, so it's cheaper. So we're going to spend $300 on our insurance and buy that away. So the money that we can make from this is $300. We got paid $600 to sell this, and then we are going to spend $300 on our own insurance to buy the strike $5 further away. And I'm always going to stick to $5 in this strategy, okay? So if you sell the 80, you're going to buy the 75 strike put. So you're selling the put and you're buying the put. They're always going to be the same type. You're not going to sell a put and buy a call. Credit spreads are always the same, okay? It's going to be selling a put and then buying a put. They're going to have the same expiration. They'll just have different strikes. $5 away. So what this does, if you buy a put, you're buying your own insurance. So yes, you're agreeing to buy the shares at $80, but you have your insurance here that says you're able to sell those shares at $75. So if the price crashes down to $50, it's okay. You can only lose the difference between your sold and your long put. That's your insurance. So now your risk is capped. You can only lose $5 a share basically in this example. Yes, you're not getting paid as much. If you didn't have that insurance, you could make $600, but you also have a lot more risk. This caps your risk. So a credit spread has a max profit and a max loss. You can't make any more than what you got paid. The most you can make on a credit spread is the difference between these two strikes, premium wise. You got paid $600 and then you spent $300. The most you can make on this trade would be $300 a contract. All right. But the most you can lose would be $500 a contract. The difference between these two. Now, granted, you have to take things, you subtract how much you're getting paid, but I'm just trying to keep it simple for right now. Okay. Hopefully this is making sense. I will go over the questions here in just a little bit, I promise. And we'll be going over and reviewing all of this over the next few sessions as well. Okay. This is what a credit spread is. And so a credit spread is simply us selling a put closer to the current price so we get paid more, and then us buying a put further away from that price so it's cheaper, and then we keep the difference as our payment. So that way we don't have to have $80,000 to do this trade. All you need to have is $500 to do this trade, and you're still going to get paid $300 out the door. Okay, making sense? Awesome. You would win on this credit spread no matter where it goes. It can go, well, almost no matter where it goes. It can go straight up and you win. It can go kind of up and you win. It can go flat sideways and you'll win. It can even go down and you'll win. As long as it closes above your sold strike by expiration, you win. And so it's a very different way of thinking of trading. Okay? It's no longer it has to stay above your entry spot. It can go sideways, it can go down, it can go all over the place as long as it doesn't go straight down across your sold strike by expiration. Win. Pretty cool, right? It takes all the guessing and all the hard stuff out of trading and puts it in your favor so that you can start making easy money. My average student walks out the door with about $800 in profits per credit spread. So they're doing one about a week, two a week. If that was you, and even if you were just to make $800 a month extra with a 90% win rate, with just as long as you're not dead wrong, how does that sound? Sounds pretty sweet, right? That could change your life. That extra $800 could change your life. That could get you out of debt. That could be the vacation. That could, once you have this skill, I can't tell you how many of my students lost their jobs 6 months into trading credit spreads, and they were like, I'm fine. And they just started trading credit spreads to replace their income. It's such a cool thing to have to reduce the stress of the world. Extra money, and you'll realize just how easy it is to make money. It's a warning right now. Credit spreads will ruin you for life with a normal job. You're going to press a button and be like, I just made $800. And it's the easiest $800 I've ever made. And again, this is just with a couple $1,000s in your trading account. You have hundreds of thousands of dollars in your trading account. You're making a lot more than $800 a spread. But let's just go the average trading account, you know, a couple $1,000s in it. You're making $800 a spread. And then you go to work to make $1,500 a week or something, right? And you're like, shoot, I can just press a button and do this, right? The temptation is to quit your job. Don't. I will walk you through what to do. Don't quit your job too early, I promise you. But that's it's going to ruin you. You are going to see money very differently. Money is going to go from very hard to get in your mind to extremely easy to receive in your mind. It's going to change everything. At least it did for me. I can never go back to a normal job because all I have to do is press a button and make thousands of dollars. And I'm like, why have a job? Right? So forewarning on that. I'm sorry ahead of time. I'm sorry. But at the exact same time, I'm not. All right. So how do you win on a credit spread? When you sell the spread, you receive money. That money is yours right away. Sometimes your broker will put it into your account for you right away. Sometimes they'll wait for you to either have the option expire worthless or until you buy it back. This strategy specifically, you are always going to buy it back. I'm going to show you how to do that. Again, we'll go over every detail and every step. This first part is just to introduce you to credit spreads, get you an idea of what they are, okay? You get paid that money as soon as you sell that credit spread. That money is there. $800 is there. Okay, if you want to get out of the credit spread, you have to buy it back. So the idea is to spend, you have to spend money to get out of it. So you want to spend less than what you got paid. So if you got paid, you know, $1,100 and then you spend $300 to buy it back, boom, there you go. You're $800 in your bank, right? Cool. So the scenario one where you can win on this is if the price of the stock moves further away from your credit spread. So if you have a credit spread down here and you get in and the stock goes straight up, what's happening to the value of these puts as the price moves higher? They are moving further away from the price, which means they are further out of the money, which means they are worth less, which means you can buy it back for cheaper than what you sold it for, right? So in this example, if you receive $500 and the price moves closer to the spread, the option would be worth more, and so you would be down on that trade. If the stock moves away from the spread very quickly, it'll be worth less, and you can buy it back for cheaper. All right, scenario number two is the stock doesn't even move at all. It stays sideways. In this case, theta, time decay. Think about it as probability, right? If the stock has to move $2 a day to get to your spread and it spends 4 out of those 10 days just going sideways or even going up, the probability now that it's going to make it down to here gets very, very low. That's kind of what theta is doing. Think about it that way. It's pretty easy to understand, okay? So it's time decay. It's no matter what, the value is coming off of it. Anytime you pay extra for the hope, that is what theta is reducing off of it, okay? If it's out of the money, it's worth 0. Theta is going to take that thing all the way down to 0. If it's in the money, it's got value, but theta is still going to take off that hope off of the price of that option, okay? Every single day that goes by, theta is taking value off of that option, the time decay. Again, think about it in probabilities. The probability now that it can make it to your sold strike gets lower and lower every single day that it just hangs out because it needs to move perfectly to get to your sold strike. Right? So with just enough time, even if the stock doesn't go anywhere, you'll make money on this because probability now, there's not enough time. The value of that option is going to shrink and you can buy it back for cheaper.